The Gini index is a tool that is used to measure income inequality in a country. Essentially, a Gini coefficient of 1 means that there is just one person that hoards all of the wealth in a country. A Gini coefficient of 0 means that everyone holds an equal amount of wealth in a country. Generally, the Gini coefficient falls somewhere in between these two extremes, 0 and 1. But while the Gini coefficient does a good job of telling us how income is distributed across society, it does not tell us exactly how that wealth is distributed and where most of the money is concentrated. A primary problem with the Gini index is that it only accounts for income and not wealth. This distinction is extremely important when trying to evaluate a country. Just because a country has a lower Gini index than another, it does not mean that the country has less wealth inequality. The reason for this can be seen in the case of America with its specific taxation rules. In America, while there is an income tax and a capital gains tax, with the former levied on income and the latter levied on income from sold stocks, there is no tax on any shares of a company that remained owned. This is logical, but it greatly disturbs the Gini index. Take Elon Musk, for example, who is a prime example of the wealth divide in America. He's extremely rich, with a net worth of $199.8 billion. Despite this, his income is $0. Elon Musk, despite his immense wealth, actually lowers the Gini coefficient in a way that reflects him as being on the lower end of the spectrum. This is due to the fact that Elon Musk does not take a salary from any of his companies, including Tesla and SpaceX. All of Elon Musk's compensation comes in the form of shares in his own companies. The Gini index fails to adjust to include data points such as those of Elon Musk, which is an immense problem. For this reason, the Gini index should not be used as an accurate final tool to calculate wealth inequality. When trying to address the differences in wealth inequality across countries, the Gini index can skew the data based on the specific taxation rules in each country. As a result of this, there must be another way to calculate wealth inequality that goes beyond just income.
Hi, as Cole rightly points out, I think a really important part of measuring economic inequality is quantifying and kind of honing in on wealth inequality. And the reason for this, I would say, is that, wealth inequality and the natural kind of distribution of wealth, unlike the distribution of income, is unequal. Economists, kind of political theorists and mathematicians have modeled this for centuries, the most famous, of course, being Karl Marx, who has a theory of capital, that is to say kind of monetary value that is held in assets like property or financial investments or factories. And he claims that capital has a tendency to concentrate and centralize, given that capitalism is kind of built around competition, and those people who hold the most wealth are able to kind of benefit the most from a kind of an economy of scale, and therefore decrease the price of commodities and outcompete those who own less wealth. Of course, in reality, this is much more complicated, but recently there was a study done by some mathematicians and physicists, maybe surprisingly, which shows through a kind of a numerical simulation that in a free market economy, the natural wealth distribution is one of oligarchy, basically, so wealth being held in the hands of the few. Why? Because what they show is that even if everyone starts kind of with the same amount of wealth, as soon as one person has a little bit more, just by chance or by luck, if we're generous, then suddenly, the entire economy is basically skewed in their favor because return on capital is always a kind of function of initial wealth invested. So, your stocks are worth more. If you've invested more, how much you can charge in rent is more if the apartment that you're renting is bigger and stuff like that. And I think additionally what we see is that, there are real kind of structural advantages and systemic advantages in our economic system for people who have more wealth initially. All this is to say that documenting inequality in wealth is incredibly important. And I think a person who does this or is really concerned with this is the French economist Thomas Piketty, who works with kind of wealth brackets and the percentage of national income that they hold. So comparing what the bottom 50% holds in wealth as a percentage of national income versus the top 5%. And I think one of the reasons that he's so interested in doing this is kind of figuring out how we can have taxation policy so that it's progressive and isn't putting the tax burden on people who really can't afford it, but people who can afford to pay a lot in tax, as a percentage of their their income. So I think, to me, documenting, assessing, measuring economic inequality and distribution of wealth is also a question of like how to structure policy and how to structure taxation.
While I believe the aforementioned critiques of the Gini index are completely valid, I don't think we should abandon its use as a tool measuring economic inequality entirely, especially for our purposes of economic policymaking. If we are looking to reduce the state of income inequality through the policy we are creating, understanding what percentage of income is earned by the top 20% and bottom 20% of earners, respectively, is really helpful. Once we understand how severe these disparities are between the top and bottom 20%, we can then begin to analyze the demographics of these populations. We can ask questions like, what are the racial demographics of the top 20% and bottom 20% of earners, respectively? Or, what are the regional demographics of the top 20% and bottom 20% of earners, respectively? Completing research on these questions will help us create targeted public policy. For instance, we could then create public policy that aims to reduce, likely through increased taxation, the income earned by the racial and regional demographics identified to be significant in the top 20%. Or we could create public policy that aims to increase, likely through decreased taxation, the income that's earned by the racial and regional demographics identified to be significant in the bottom 20% as a means to promote wealth equality. How significant these taxes are increased or decreased can then be adjusted based upon how severe the income inequality has been identified to be based on the data from the Gini index. The Gini index and the 2020 ratio are not only helpful tools in economic policy making itself, because they will also help us measure how effective the policy we created was down the road. In the future, measurements from the Gini index will allow us to see how the severity of the income gap changed in response to the implementation of our public policy. If the Gini index were to experience a significant decrease following our policy implementation, our policy can be considered effective. However, if the Gini index were to increase or remain constant, our policy can be considered ineffective or even detrimental to wealth inequality. Once again, we can then dive further into the data and examine the racial and regional demographics of the top 20% and bottom 20% of earners. We can use this analysis to discern how our policy impacted the specific racial and or regional groups we wanted it to target.
As Ava just mentioned, a significant and incredibly relevant wealth disparity is what we call the racial wealth gap. In 2016, the average wealth of a Black household was $140,000, while the corresponding level for white-headed households was $901,000, which is nearly 6.5 times greater. In Boston, those numbers are even more staggering, with the median net worth of a white family being $247,500, while the median net worth of a Black family is no more than $8. As Maibritt explained, wealth accumulates, and because capital is a function of initial wealth, historic economic discrimination and inequalities have continued to grow, even as some of the legal framework surrounding them has been changing. Many economists have pointed to differences in rates of return on investments and intergenerational transfers as some of the main forces behind this long-lasting disparity, and have concluded that differences in labor income weren't large enough to be the driving force behind this inequality. However, there was a recent paper by Ellie Prentice and Carroll which critiqued the earlier approaches for underestimating the importance of initial conditions and income disparities for future wealth. Their model makes predictions about the types of wealth gaps which would be observed if one or more mechanisms behind the wealth gap are changed at a time, whereas some earlier studies have been more single-handedly focused on one specific point in time and what things look like at that point. So according to their estimates, the racial income gap can account for the racial wealth gap almost entirely on its own. And when they removed the wealth gap in their model from 1962 and onward, they saw that the Black to white wealth ratio would reach 90% by 2007. This one finding, of course, isn't or doesn't mean on its own that we ought to always consider income inequality as the most important force behind disparities. And since there are so many different researchers that has come up with different models, it's definitely important to take it with a grain of salt. But we might also not want to be too quick to dismiss the significance that income inequality can, in some cases, have when we're attempting to create policy solutions to increase or decrease these wealth disparities.